Hello, hello, good afternoon. Welcome to another video of ES Futures Trading. Today is Sunday, August 6th. It is 4:23 Eastern Time in the US. What I wanted to do this stream, well, this is live. I don't do any editing here, or to check what or where the market is at, what was happening, what is happening, and what can happen also down the road. It is very important. I repeat this over and over. It is very important to do our homework. The homework is fundamental to trading. Every time the market closes, this is what I do. Sometimes I take a break and do my homework late, very late in the evening. But if I don't do my homework, I don't trade. As simple as that. I just don't trade. That's part of my rules also. I have every time I build simpler rules, that I have. This is very personal, right? Everyone need to have rules that we need to be, we need to abide to. One of these rules is if I don't do my homework, I don't trade. Just as simple as that. I don't trade if I don't do my homework. And the base, it took me a time to understand why is that important, because trading is a performance activity. And if I am going to compare trading to any other profession out there, to any other business that is, in every business, every career, every job we have, we feel prepared. If you're going to be an accountant, a lawyer, or doctor, you just go to college, right? You go to college for 3, 4, 5, 7, 10 years, whatever it takes to have a degree, and then you start to practice. You do your practice, and the more you do, the more you practice your job, the better you become. That's a preparation and then repetition. In trading, the preparation is every single day. Every single day. And we don't have repetition. We don't have just a repetition. We have repetition with variation. And we perform. Every single day we have to observe the market. We must observe the market before we perform. In the same way as an athlete, as a football player, a soccer player, they train, they prepare, they watch videos during the whole week to perform for 90 minutes. We do that every single day. There are no 2 days, there are no 2 trading days that repeat themselves. The odds that 2 days, I have never seen that. My career is not that long, but I have never seen 2 days that are similar to the exact same. There's always some variations. Nicholas Taleb, in his book Fooled by Randomness, says something that that kind of illustrate. For a day that repeats itself, everything, all the participants on that day have to be the same the next day. And not just be the same, they need to think the same like the previous day. They need to do the same like the previous. And what are the odds that happen? It's just incredible, basically zero. That's why it's very important to do our homework. I'm going to pull now. What I'm going to pull now is I'm going to pull the bigger time frame charts, which is this one. All right. Here we have the monthly, we have the daily, my bad, we have the weekly, and the daily up here. These are very just I put these three together. You know, I am always adjusting. Right? I can see three at the same time, and then I dig deeper into each one. We have big range, 14-month range in the monthly, and the breakout of the range. And now the breakout is the 43.27, the breakout level. The market is far from that breakout. This monthly is as from an inside bar. It is just the first week into the month. We still have 1, 2, 3, 4 more weeks to go this month, and the trend is to the upside. There is no excess here at the high in the monthly. The weekly kind of like gives us giving us something slightly different here. This is the range. This is a big range. The breakout of this range. You have a breakout of this range. And the market took this high. Breakout or upside continuation up here. This I don't consider this a gap because this is a gap that happened when the contracts did roll over, and the market formed a range. 1, 2, 3, 4 week range here, and then continues. It had another breakout to the upside, no excess at the high. The market sold. You know, this is a nuance to me. Has no excess at the high here. I know you can see the monthly. It is the same reference here, and these lows are kind of close, very close to each other. This mechanical buying here. That's what I can say. Now we have a breakout. This is curious, right? I have seen this line here, this trend line. I'm curious. I am going to be watching this. If this market buys from this line, or just take this breakup, this trending line. I don't use this to trade, but to monitor what happens. You know, if there is a bounce here, look at it happen. It just happened here, right? In this 1, 2, 3, 4 weeks, back to back to back. You know, even this one, buying from this level here. That's just kind of started to catch my attention. And all that because in the daily also we had the same thing. Now, this 2-week range has been, there was a breakout to the downside, and the market is being bought exactly from the high of the range. If the market comes back inside, this is a critical level now, the 4,500 here in the weekly, okay, the weekly. Buying from here, it is, you know, it just puts a lot of questions. If there's an upside continuation here, it's going to be very questionable. Very questionable if that happens. Now, if the market re-enters this range, it can target the opposite side of this range in the weekly time frame. I'm talking about the weekly time frame. Forgot about this line now. But there is something that can happen here as well. If there is a look below or look inside, and then the market rejects, you know, penetration of this range. If the market gets back inside here and comes back out of this, you know, that will put the high on side again. It doesn't matter how far it is, but they put this high again as a potential destination trade in this time frame. I'm not saying that's going to happen, but the conditions of the inventory is what is telling me that. It will be what can happen here, right? After that. If that's the weekly. Now, the daily. Okay, let's check this one. This is the monthly. This is the weekly. We talk about those two. You have this reference, non-excess on the high, selling from that, very mechanical selling. And now the daily. Notice how all three have the same reference on the upper side. And the weekly, monthly, and daily have. It doesn't always happen that way. It is worth to notice that. This not always happen. That doesn't always happen like that. And what's happening in the daily time frame, this is very elongated to the upside. It was, when we were talking about this selling here or this buying here, getting away from the 50 SMA. This break here, the break that we are witnessing, has put all of these longs here are already out on the market. This was weak buying here, a very questionable buying here. That long inventory has been removed. That's not anymore in the market. Right out in the market. Now, remember the range that we have from the daily time frame. My bad, from the weekly. Do you remember this range? Okay. It can be seen in the daily here. And before last week, we were talking about these two ranges here. One range here at the bottom. This one. We talk about that, I guess. No, in the somewhere I don't. No, this is the two range that I'm talking. We were talking the last week how there was a separation of this range. In the same way how we have distributions in the intraday, we have a market profile, we have upper distribution, lower distribution. Sometimes we have 2, 3, 4, 5. The more distribution the market profile has, the more emotional that day is. And they were very clear here. This distribution very clear, and they were separated with this single day here. Now the market has closed this distribution. The next thing here is what the market's going to do here. What can happen? Coming back inside this distribution actually puts the opposite side of the distribution as a potential destination trade. In the same kind of trading that happens in the intraday happens in all time frames, happens in the daily, weekly, and monthly. They don't usually happen at the same time. When they happen at the same time, for example, if the market comes back to this high, we know that high is a reference for all time frames. It's for the daily, weekly, and monthly. If the market comes back to that, I'm not saying it's going to do it, but when it does, it's going to be, everybody's going to be watching that. Now, when everybody's watching something, when everybody thinks that something is going to happen, watch out, be very careful, because right now, the talk in the street is, this is a pullback. This is a pullback that the market needs to keep running higher. It's kind of like a consensus out there. Everybody's thinking about, saying about that. More, or at least most people. This is healthy for the market. A pullback is needed. The market is going to come back to the highs. I'm not saying it cannot go back to the highs, but that's a consensus. And when everybody agrees on something, you just be very careful. We have to be very careful when that happens. Now, from Friday is an outside bar. It's not just an outside bar, but it's an outside bar to the downside, which have closed the distributions. We have put the opposite side of this distribution on side as a potential destination trade. There is something else that can happen. The other scenario, if the market trades back inside this range, the 50 is not that far from where it is now. The 50 moving average, which is a reference that a lot of short-term traders look or watch. There's a gap below the current. It is incredible how this happened on Friday. Now, the market was very close to get inside this gap on Friday and just ended trading inside the gap that the market has at the lower side. It's unbelievable how the markets are unpredictable. Markets are irrational and unpredictable. Nobody knows what's going to happen. We just try to be in sync with what is happening. and we gather a lot of information that's going to be useful and just a certain, any given. We don't know when this information is going to be useful. That's the thing. We gather a lot. Friday was one of those days that have a lot of information. Has a lot of information. You could think that maybe Friday Friday was not hard to trade actually. Um, the market was to the downside, the trade was to the downside. Value, you could see some selling the previous day here, but the market opened to the upside. It was very questionable. You have to be very, very, very aware about what was happening. There was some selling when the market re-entered this range, and overnight inventory was 100% long. The selling that happened as a counteraction to the overnight long inventory was more than just a counteraction, and that's because of the volume. Okay, but we are not here. I guess I am going too far here. Now, what do? Okay, before going any further, I need to do something here. Okay, what am I going to do? My bad. What I'm going to do is I need to take a screenshot of the schedule for next week. These are the news for next week. Okay. We do have CPI on Thursday. We have PPI on Friday. What else could be relevant? Maybe consumer sentiment as well. And the actions here. Okay. Now this goes to my notes. As part of my homework. Now, the next thing I need here is I'm going to put this one back where it was. The next thing is the earnings calendar. I do have here earnings whispers, and this is calendar. What do we have for schedule for next? What do we have for next week? Okay, screenshot. Relevant, I mean. Disney, but this is not going to move the market. Well, no, basically there is not. Basically, there is nothing. Okay, I want to. There's nothing really for that could have an impact in the trading that is for the next week. Okay, nothing. I guess the market is going to be focused in these two events. Okay, and the market can focus as well in the stocks. If there is nothing that's going to impact the market can, pay attention a little bit more to stocks. And to go to that, let's take a look at the monitor. What I have here, I have the dollar, crude, and something I think is relevant here is the bond market. what's happening with the bond market is market is very close to these historical lows here. You know, same goes to this. I guess I don't need this one anymore. You know, it was the last week on Thursday or Friday we were talking about how this market has been in sync, has just got in sync. I mean, both them very close to the historic lows and at critical level. This one took this level out, get close, and both were bought from this historical low. This is 2022 low, which was 2011 low. The thing is, if this market keeps trading to the downside, it just can, it can drag the market down. And if you add the dollar here weakening, if the dollar weakens, this is not. Is this relevant? No, this. Okay. This was relevant for this break. Notice how many times it was bought. Exactly, these two levels exactly buy what from here and there we have and all of the long inventory being liquidated and getting long again. Very mechanical, this dollar. But why is it mechanical? Because you can see the trend line here. Now somebody just trying to catch a knife here in the bigger time frames. This low is a historical low as well. No, it's not a historical low. It's just mechanical level. He's being bought exactly from this. What is this? It's not even yearly low. Nothing. But the thing is, when the dollar weakens, it can have an impact on the big tech. That's my main concern here. It can have an impact in big tech, and all of these companies. Well, okay, I guess without, all this big tech can really have be impacted by that. Now, starting Amazon, for example, Apple can be crushed if the dollar. The earnings are going to drop. It really could have very impact if the dollar keeps weakening. Now you have Amazon here. What's the next one? Let's just check what is going on. This is a range here. This is all the money is coming to Apple here. Incredible trend. You can put a trend line here basically and buy from there. Amazon has closed the gap. This gap now, I'm going to put this gap here. This is gigantic gap. This is not good. It's just, these kind of reactions are just too emotional. Another one, this is, okay, that was Amazon. What about Google? Oh boy, this is another gap. This is just not to trade in a bubble, to have an idea about this. Because this week, why I'm doing this? Because this week I think the market is going to be focused on, maybe it's going to get focused on more stocks. Like Meta, how about this gap here? And notice how many gaps Meta has. Really big gaps. Is 1, 2, 3, 4, 5 gaps. This is 2. It looks like it's too elongated to the upside. Let's check Microsoft. Notice the support here around this level, right? The 320. If the level is taken, 325. If this level is taken, there's, they can come all the way down to here. What about Netflix? Huge gap on the opposite side. This stock is going crazy here. There's a gap here that hasn't been closed or solved from the map. Look at this, center of the gap basically. Okay, I'm going to put another one. And there's another gap here. Just, and why I do this is because some gaps are sign of emotional trading. There's another gap here. Is this a gap as well? Yes, this is a gap. Short, tiny gap, but still a gap here. Same thing. 1, 2, 3, 4, 4 gaps to the upside, and we have these big gaps to the. About Tesla. God, look at these gaps here. Oops. So many gaps here in this company. This is to not to trade in a vacuum, right? Just trying to 1, 2, 3, 4, 5. Support. What is support? This is short covering. What you have here? Short covering to close this gap. I don't know. There's no more above this. Okay. The market could pay attention to stocks this week and maybe next week as well. We still have Home Depot, Lowe's, Walmart, Nordstrom coming. Maybe the week after this. Now, let's take a look at market profile. From Friday, we got 1 distribution, 2 distributions, and 3 distributions from Friday. 7 and last are the same. The market traded inside this gap, but closed inside the upper distribution. What do we have below? We have this gap here. There's nothing here below this low, nothing there. This is the high. This level here, the 44.79, is a high of this range. If the market can close the gap, it also can, it puts this range on play. Downside continuation targets the opposite side of this range when the market takes this low. When the market closes the gap, I mean. Now, the upper side, it was a very mechanical selling here. From this day, 823, A2. This is not good. This is A2. August 2. The fixed period. I have big volume areas here. It took this one. There was another one here. It just was sold from that level, but it didn't take it. It didn't take it. If the market comes back and check this level out, there could be some serious upside here. Because there's nothing here. There can be some buying here, and there's nothing above here. There was 2 distributions, very significant distribution from the overnight, which means that inventory is in big hands here. And remember something going on here. This has played out. What happened here on Friday? You have to remember what happened in this day. And most traders won't remember what happened in this day. There was some serious selling here in this day. Okay. At first, I called this, I called that a buying, but there was some serious selling here. Or the most neutral approach was some serious accumulation of volume here in this day. Let's see if I can recall this. Maybe I can from yesterday, from the previous day. Yeah. No, this is not. Oh, okay. This distribution close here. Yeah, spike base heavy volume here in 7-1 on this day here. Really heavy volume here. And these distributions play an important, something important, very important role in what happened last Friday. Once this distribution close, the next thing for continuation is taking this high here, this one. It didn't. When the market closed these distributions here, you could also see it was somewhat. What the heck is this? Okay, let me do. Where's my volume here? Okay, I need to fix this. Okay, and you can see the market went higher here. Volume was higher when the market went to the downside first, and then just volume started. Volume was a giveaway. The decrease volume was a giveaway on Friday. Let me explain it. The reasoning behind that. In this market on Friday, we have a downside movement. Value on the day previous, value couldn't be moved. At least not inside value, but at least not even to overlap into lower. Value was lower. We were talking about how some sort of liquidation was expected. If this value cannot move inside, some liquidation, some rotation happened, but the buying here was very mechanical, and this selling here was with volume, which suggested that this was more than just a counter action. But as the market went higher, volume started to decrease. We pointed out how these markets on Fridays were just having low volume and big rallies. Traders are well used to do that, Every Friday we have a rally, but this is not going to be different, and it gives us something. When the market came up here, this volume started to decrease. Each time was lower and lower and lower. I noticed how volume started to increase when the market started to break. This was a weak reference from the previous day. The next day was bought from the same level, which was weak, right? And I traded in the right direction, but I just closed too soon. Something I did not, even you do your homework, right? When you start doing your homework for the first time, you do your homework, you plan your scenarios, and as soon as the market opens, everything goes out the window, because you forgot about everything. But the more you start doing it, some of those things remain in your head. But something that it was my mistake, is when a market re-ended, has a breakout, in this case the daily, remember the trend is to the downside, has a breakout of the daily time frame. And notice also how this day was bought very much from POC here, from the previous day. When the market re-enters this range, the potential destination, remember this is just potential destination, right? Is the opposite side of that range. Now, I'm not saying that every time that this I see the market coming inside or back inside after a breakout is going to trade to the opposite side, because that's the doom of traders. Traders think that because one thing happened before, it will happen again, and we have to be constantly observing the market every time. Every time is different. We try to focus on what is happening now, not on what will happen because something happened before. It is true that what is happening now has a lot to do with what happened before. Remember, remember the daily. How many gaps this market has? How elongated is to the upside? No, how close the market is now to the 40, 46. What's happening? We talk about this, right? What had happened here? This is a range in the daily time frame. This was a range intraday, right? What happened here? Remember, the way how we trade in one time frame is the same way you trade in the another time frame. The same reference, the same potential is for all time frames. This is the daily. It has to re-enter in this range, targets the opposite side of the range. Is it going to happen? I'm not saying it's going to happen. I'm not saying that. You have to be aware what is happening. Now, this break now, what's happening with these breaks? One big break here, another one here that have an inside. This, remember, this is balance here. We talk about the balance here. Break out the balance, go in the direction of the breakout. And monitor for continuation. That's why we have these labels as for monitor for continuation. What I cannot avoid this, but to notice the volume here. You got 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6. I mean, this is huge, right? This is huge. It happened just in half of the session, half of the day. This make this range. When we have this kind of volume, it is very. I question. All right. What is the volume? The volume is a nuance to me here, and also we have this market high that was made in the overnight here. I think the market. I mean, for me, this is a crucial level here. This is very, very, very key level here. The market can keep going to the downside. It can have a big bounce to the upside, or it can give us, or we can form a range here. Trading, keep accumulating value here on this side. Just before, in the same way how he has a range here and balance here, the same thing can happen here as well. Right, and this is the thing about trading. We never know what's going to happen. You find somebody, if you know somebody who knows what's going to happen, please let me know. I'm going to buy the house. I'm willing to buy the house in that. No, but we never know. And actually, nobody knows this. What I have to do is just monitor. What I can see here is kind of like an emotional day. There's a lot. First, we have three distributions here. We have three distributions coming from a sell-off that happened in stocks, happened in Apple. And there's nothing There's absolutely nothing here. There's no support here below this day. The day closed at the low. Nothing here below. There are single prints here. Single prints here. Easy for the market shouldn't have any troubles going through this here. And this is also a spike. Was a spike base. The 15 moving average is inside this profile. Weekly inside buy high. What is this? I guess this is irrelevant now. Let me check this because that was a weekly inside bar from, it was this one. Instead of that, I'm considering the range high here, 40, which is the 4,500. And the 4,500 is right here. 4-day range, what it is. Come on, okay. 4-week range high, that's what I have. That's why I consider this is a very important level. And the market could, it's time to, I call this a decision-making level. Jim calls this a go, no-go level. Right. I try to remain neutral as much as I can. The market is very weak in the lower side. The selling is very mechanical, doesn't have the volume. Everybody is concerned that this is, everybody thinks that this is just a pullback, something that the market needs to keep going higher. Be aware of that. And the next thing I want to do here is just play Jim. To play Jim market update the week ahead. And I like to do this every time I do my homework. I do this just because I use him as a benchmark. I was on several of his intensives. I got many of his courses. If you can go and have him one or two of his intensives, you know, those are not cheap, but they are very well worth. Okay, let's play this.
The previous reports.
Okay.
Good afternoon. We talk about the week ahead, and the word that comes to my mind is continuity. If you have been a steady follower of our weekend comments, you may recognize the continuity of the previous reports and how today meshes with those. Stage 1 focused on the pain trade. The pain trade is that market action that causes the most discomfort to the greatest number of players. The pain trade was fueled by longer-term investors being underinvested or not having assumed enough risk. As they felt the pressure when the market rose, they were forced to buy to be competitive. Stage 2 focused on market structure, which indicated that the rally was in its latter stages, being driven mostly by laggard short-term momentum traders. That was the bar chart we showed recently, where 11 out of 13 days, the market went down to an exact trend line. That is usually the kind of behavior to expect from the laggard or the weakest of momentum traders in the market. Where we are today, we have the potential, and I think the odds are pretty good, of entering into stage 3. Stage 3 would be under conditions where the market goes into a more serious liquidation stage. In order to get the market to roll over as it has recently, it usually requires a catalyst. It's something we've talked about before. The initial catalyst was Fitch's downgrade of US debt. I believe a likely second catalyst occurred following Apple's earnings on Thursday afternoon. Apple is a major holding in over 300 ETFs, in addition to being overweight in multiple institutional portfolios. We have constantly identified the 4,500 level as support. When you look at the graph in front of you, acceptance down below the 4,500 level and closing the gap gives us great odds that the market can enter that lower distribution. Once it enters the distribution, the goal or the odds so often are that the market will rotate down to the lower end of that distribution. That's what we'll be looking at Monday morning. I think the most important economic release of the coming week is core CPI to be released on Thursday. Have a great week.
Okay, that was very. I hope you have. I love those updates because um, Jim has a Jim has a bigger time frame view of the market. It's very aware of what's happening, and we must have that goal as well to go to be at that level. We may trade different, but what matters here is the view, the panoramic view that this has. We were talking, for example, how now we got we got Apple here, right? Apple, what happened? What happened in with Apple on Friday or Thursday? What may happen with Apple also if the dollar keeps weakening? We talked during the week also about the Fitch downgrade of the U.S. debt. Now, something that he mentioned that's very relevant for any trading for any time frame is not just taking these levels, these key levels, but what happens afterwards. There's nothing here below. The key would be, if this level is taken, building value below this. Building value shows that lower prices are being accepted as well. Because remember the three components of the market. You have price that advertise, time that regulates, and volume that shows the success or failure of the opportunity. And that's when we trade. All those things we must be aware when we have this, when we observe the market. The three stages that he mentioned also about the pain trade. What is happening? What may happen? And what what I really admire of him is that he has history. Being a trader, being trading or being in this business for over 50 years is not something that is that you can just ignore. I appreciate that. I think that he is willing to share that thing. Of course, that he has some courses, he sells his educational courses as well. But this information here is out, and it's very useful. It's very useful for the way, at least for the way I trade. I try to be different. I aim to be different. I understand that most of the traders don't last. Over 80% of the trading accounts, most of the trading accounts are closed in the first 3 weeks. The remaining are closed in the first 3 months. And this is what happens. And it happens all the time. It happens over and over and over again. And the first thing I realized after painful, it is really painful. We have to survive this business and survive the cycles that we have here. And if I am going to trade in the same way as the 99% or 98% of people or small or retail trading trades, how come I can expect a different outcome? That's something that just it is. How can I expect something different if I do the same? But that's when I started doing. That's when I started to look for something else. I discovered market profile. Um, you know, and after a while, after a short period of time actually, that I started this, I discovered Jim Dalton. I didn't read his books, but what I read is a lot of his references or his his recommendations, which are here, and the books that he has here are has nothing to do with trading. This is about self-understanding. You just start knowing yourself because that's very important for trading. Getting to know yourself. I was because uh, I was wondering how can I explain this, right? But just let's see. Okay, kids play soccer. I guess this is what I did. Um, Not talking about. Let's see. Okay, look at these kids, right? Look where the ball is. Where the ball is, right? And where are the kids? All them behind the ball, right? All them, and you will watch this every time. You have the ball, and everybody's running towards the ball. But I can call here. What is this relevant? It has nothing to do with trading, right? Has nothing to do with trading. And these are very young ones there, and you can see this one, but they are learning how to play here. And what happened is in trading, everybody or most people follow price. People traders just follow price. These are more older players, but still look at how they gather, right? How they gather. Where is the defense? Where is the offense? For example, as you grow up in your business, you start to play a game, not just following the ball, which in trading, if I'm going to do an analogy, it would be price. You start to see, but when you follow price, you are just seeing this area here. You don't see what's happening here, what's happening here, what's happening in the back. And that is the time frames. Those are different traders, different time frame traders. There's a daily, weekly, monthly time frames, different participants, because the market is not just made by us, retail or small traders. There are participants that just buy, never sell. There are participants that trade huge capital. And there are us. And getting to know what is here is when we have this panoramic view of the market. Having a panoramic view is not just having an appreciation of what the bigger time frames are doing, but this keeping what they are doing while you are trading, right? Trying to identify who is playing, who is doing what. Okay? Because if somebody small is doing a movement, what is called, if I'm going to go long and the market go against me, I'm going to close, and you are going to close probably as well. But if a bigger participant, one participant that has a view more than a day, that's planned to stay in the market for weeks, for example, he's going to stay in the market. And which one is my competence? That's very important in trading. It's very relevant. And now, getting to know yourself, you may have qualities to be a goalkeeper. You might have physically or mentally, you can be a 10, which is the creative the creative position in soccer, for example, you can have the physique to be a defensive player or to be an offensive player, but everything that's just part. If you have the physique, if you have the conditions to be an offensive, but or a defensive player, but you want to play offensive, acknowledging that will means that you know what you need to do to be the player you want to be. You just don't go and be it is going to be harder if you don't understand what kind of people or what kind of trader you are. Acknowledging that is very important because it allows us to do the work that we need to get over there. What do we need to do to achieve our goals? And that's just one part. And then the market is the whole game. Having a panoramic view is very important. The bigger the game, you have seen these coaches that are even placed in football. We have coaches that are up in the stadium watching, having a panoramic view, for example, right? But it depends on what kind of coach you are. It depends on what kind of participant you are in the market. Most traders fall for a trap of price. You just follow price. Everybody's running here. Everybody running after the ball here. Look at this. Big spot. Everybody. Who is here, for example? Nobody's here. Right? Same thing goes on trading. Got to be aware. This is just a trap. Price is just advertisement. Price advertise. Market going to the downside, advertise lower prices. Market going to the upside, advertise higher prices. But that's just one component of the market. It's at the beginning is very hard. Trading is not easy. There is no exactness in trading. Every single day we have to be prepared. We have to do our homework. I need to watch the market. I know what kind of trader I am. I am a short time frame trader. It doesn't mean I don't care about what happened before. But what happened before is very important for what is happening today. And I try to be aware of that all the time. Having this weak low here, weak low here, weak low here. Why are weak lows? What are the odds? I'm thinking in terms of odds also is very important, but it requires time. I observe the market, I watch the market, and then made a decision. Right? I take a risk, and always have to take a risk, and that's very important as well. I remember, there was one of my single rules is don't trade breakouts, but because I used to call this a breakout or this a breakout here. What relevant is daily breakouts here. Daily breakouts of the daily. But those are just simple rules. I keep knowing myself. I keep adding rules or removing another ones because the market changes all the time. There was a time, for example, when I pay a lot of attention to what happened. And these lines, for example, these arrows here, there's a big volume blocks that happen during this trading day, for example. What would I do with those ones? They used to be relevant to me. They are not relevant anymore. And I used to write the number, how many contracts were bought at one single bill and in one single transaction, for example, right? Somebody buying 5,000 contract is not the same that 5,000 traders buying one contract. And how do I know it's buying? How do I know it's selling? I don't know. Nobody knows that. I can have some idea. For example, if let's check. Here, for example, if I want to open this in a browser, so I can highlight this. Somebody buy 800 contracts here. One single transaction here. If I see the market having a spike to the downside, then probably that's selling. Probably there's some selling happen here. You know? But what is the context of that? By itself, it doesn't mean nothing. We have to put everything in context. All of these references, all these things are just single piece of information that doesn't make any sense. And when we put things in context, is when we start to see a bigger picture of the market. Right? I think for me, for the current market, for the current situation here in the market, by the way, I do my homework every day, right? On the weekend, I check with Jim and see, what he say about the 3 stages that when he talk about 3 stages, there's something, for example, I didn't. Just experience can give you that. Right? We always getting new information. Always, all the time, we are learning. This, for example, here, right? By itself doesn't mean nothing. What are these red things, right? I used to have here, this is a comparison between elapsed time, contracts or activity by second. At any given price, if I have this price, for example, let's call it this 40, just for the sake, 4,500 here. How long the market stays at that level. What's on the left side, it stays 1 second, 60 seconds, 2, or so, throughout the day, and how many contracts are bought or sold at that specific level. And this is a comparison between those two factors, right? Those two indicators. If I didn't know how to use this, how you use this information? The only thing that this is useful for me is I know that there's a congestion here. The market trades a lot, back and forth. When the redder it is, the higher the congestion around those areas. By itself doesn't mean nothing. But when I compare, for example, when I got this here, really high volume, overall, in the period, there's not that much. Because when I have consideration here is when I see, for example, I see 12 or above 10,000, about 10,000 contracts. That's some volume there, and that happened. For example, this day. Let's open in the browser again. There was nothing, just single, very, very, very light, very thin market on Friday. Very thin market here. In this break, there's momentum, blue momentum. There's no back and forth, pure momentum, pure, just emotional trading here. By itself, it doesn't mean nothing, right? When you put things in context, no volume here. There's some maybe 9,000, but no volume here, until something comes here, something happens here. There's 1,000 contracts here. Not too much. This is about 50s. This is about how much? 150s. But notice how the volume is here, higher. 12,000. Oh, okay. There's some accumulation here, and this was the daily. The daily low was right there. And when I have these kind of levels, okay, this is something. If there's any problem here, it's going to happen here. This is when traders, bigger, this is professionals do trade this way. If you have this level, this key level, you just take profits here. And if the market keeps going to the downside, they re-enter. They may re-enter below that. The next thing or next key level, and they may not exiting this, they actually may be exiting the 4,500. Okay, they just get out, take profits there. If the market keeps going to the downside, they may re-enter below. And that's how bigger trading is. Just tried to get that. It was hard to get that inside my mind, but that's how they do. For me, it makes no sense. It didn't make any sense because I have the mind of a short-term trader. That's why gym is important. It gives you the insight, you know. And when he said about, he talked about the underinvested, under, not underinvested, underexposed, right? They don't have too much risk. About when he talked about the pain trade, these are bigger companies, right? Bigger hedge funds. They are they are not they manage money. They are hired to manage capital, and the way how they are measured is against their peers. If I have, you know, 10% profit, 10% returns, 5% returns, but the media is, for example, is 7, I have 5, I am lower. Okay, I'm losing. If I have 15 and the media is 7, I'm being too risky. I might get fired, actually. You know, the hedge fund manager can be fired because you will say, why? That's crazy. But that's how it is. You know, it's perceived that that person, that management is taking too much risk. And those are multiple things that we just need to be aware. I try to remain as neutral as possible going into the next week. And if I have any bias, you know, I am trying not to be so focused on the lower side because everybody's looking to the upside. Right? Everybody thinks that this is most people think this is the break that the market needs to keep going high. No, we talk about what we have in the upper side, what we have in the upper side, in the lower side. Just I try to remain neutral for the week. Okay, I wish you guys. I hope this is useful for you. I use this stream, these videos to clear up my mind or try to organize my mind and put my thoughts into, or words. To have, if it is useful for you, I hope it is. Please just let me know. I am doing what I'm doing. I'm using. What is this? What is this? Hold on, just a second. Okay, this is my tweet deck. Okay. I am posting because I am not doing. I have realized that the streams that you used to do in the mornings when the market opened, it was keeping me from having. I was missing opportunities. This is my Twitter. This is my Twitter here. Is futures trading here. At e-mini, and I kind of like put. I on Friday I couldn't do it on live. Because it was so just too much information. But after I closed, I started to put something here. If I see something, I put it here. And if I can do it, I will do a stream. I do a stream at night at 8:50, from 8:50 to 9:30. If I can also, I used to do everything every time I can. I do a market update at 12:30. Okay. All right. I wish you guys a good week. Stay safe. Hope I can see you tomorrow. Bye bye.